All right, team. We welcome today Miss Krystal Miles. She's amazing, wonderful, incredible, amazing loan officer. Was actually in real estate for 10 to 12 years. I think, was it 10 years?
Yes,
10 years?
well, 13 now.
13 years before becoming a mortgage lender. She's incredible. She's awesome. She's part of the team. And today, in learning about loans, we are going to learn about.
The MedPro Advantage program. It is a program that's for medical professionals, specifically doctors, but it does include PAs as well and different types of
Nice.
doctors.
So the Med Pro is like the fancy way of saying it, but medical professionals program for doctors and physician assistants, from what I just heard. Is that correct?
Yes.
Not nurses.
No.
Okay. So a lot of times, just to be very clear, there are programs where medical professionals can qualify, nurses included. A lot of times the nurses, if I'm not mistaken, get put more under like first responder type programs. Is that true or false? Am I making that up?
Yes, that's correct.
Okay. So this one's physician assistants and doctors, medical programs. And again, we'll hit some of the details, but fill me in on what, again, guys, we're going to talk about from the angle of kind of what we know and what we have to offer. And then we'll talk about what else is out there in the industry that maybe is not necessarily something that we offer. And we'll explain why that is. But Ms. Krystal, take it away. What do we need to know about this program?
So the MedPro Advantage program that we offer is a low down payment assistant program for doctors, which a lot of times when doctors first go out into the field, they just got their job, they've just graduated their residency, they don't have a ton of money, but now they're getting ready to make all of this income and want to buy their first home. So our program offers a low down payment of minimum 5%, but it also doesn't have mortgage insurance, which is important because a lot of conventional products, when you're putting 20% down or less than 20% down, it comes with mortgage insurance. So, this program offers the low down payment assistance as well as no mortgage insurance. And it also has fixed and ARM rates
All right.
available.
So that's a ton. So let's go with the down payment assistance first. So when you say down payment assistance, do they give them the 5% for the down payment?
No, they have to have 5% of their
So
own
they got to
money
come in with
gift
the
funds.
5% on their own. So I'm going to ask the question, and yes, I do know the answer on this one. But Krystal, Fannie Mae and Freddie Mac, they allow for 5% down. Why don't they just do that? What's the difference? Why don't they just go normal Fannie Freddie versus using this medical program?
The interest rates would be more favorable with this program. And like I mentioned earlier, if you're putting less than 20% down with conventional products, you'll have what's called mortgage insurance. And mortgage insurance can add, anywhere from $75 to a couple $100 to your payment each month for something that goes towards nothing but insurance.
So that's the key right there is hundreds, many hundreds of dollars for, and it depends on the loan size too, right? The bigger the loan, the bigger the mortgage insurance is. So in the other part, mortgage insurance is typically not going to be tax deductible for somebody in the medical profession because it does phase out after, huge round numbers, call it 110 grand household income is where the tax deductibility of MI goes away. So for having somebody like a doctor that goes from making literally, 30, $40,000 overnight to suddenly $400,000, literally, in the moment, in a matter of a week, right? They graduated from residency and now they're going to be a grown up doctor. That's the other benefit of not having the mortgage insurance is now that's just money being spent when they don't have to. So did I hit that part right? Is that correct?
Yes, that's correct.
Cool. What about loan size? How big of a loan can they get? Like conforming, like Fannie Mae, Freddie Mac? Can they go up and do jumbo
Actually, we can
financing?
go up to a $2 million loan amount on this product.
That's amazing. So can you still do the same 5% at the 2 million? I can't imagine that's true.
You do have to have 10% down when you're 1.5 to 2 million, but anything under 1.5 million, you can do 5% down.
That's ridiculous. So just to repeat what I exactly verbatim what you just said, if it's 1.5 million or less, only 5% down.
Yes, that's correct.
Wow. So that to me is the big one there because again, if for those that don't know, 1.5 million loan amount is going to require typically minimum 20%. It could be even 25% depending on the lender, the investor, et cetera. So this medical program allows for 5% down payment when you're buying 1.5 million or less, and 10% when it's 1.5 million to 2 million, which is crazy to me, but that is awesome.
Yes, and a
Um,
lot of our jumbo products would require more than that, and you are getting into jumbo loan territory when you are getting over about $806,000 in a loan amount. So that's really advantageous, and the interest rates on this product are very, very good.
Good for us. Good for you. Good to know that. That is incredible. So in this program, the reason why Krystal said the 806, 806,000 at the time of this taping, so in 2025, Fannie Mae and Freddie Mac, they set the limits that basically dictate jumbo financing. And right now it is that 806 number and some change, but it's
Yes,
806. It's 806. So if you go above that, you are jumbo. So the point is that through this medical program, you avoid the jumbo financing, which typically means higher rates and tougher underwriting and more down payment required.
that's correct.
Let's talk about that. So the down payment we've just established is super awesome. What about from a income standpoint? Is it normal underwriting from an income and liability? Or I know some of these programs sometimes can ignore student debt. Like what's is there anything funky with underwriting, or is it pretty just straightforward, like quote normal loans?
It does have a little stricter debt to income ratios where, conventional products can go up to 50% debt to income ratios. This one is restricted to 43, and you are required to have 6 months of reserves of your payment, which that can be in retirement funds, stocks, or any other eligible assets. So it doesn't have to be in your savings or checking account. It can be in other asset accounts to cover those reserve requirements.
So reserve requirements just means that if the mortgage payment, let's say, is $5,000, we'll keep it easy. You said how many months of reserve? 6.
6 months, yes.
So if they need 6 months of reserves and your whole mortgage payment, let's say taxes, insurance, everything all together is 5 grand, they're going to need to want to see $30,000 left over after closing somewhere.
Yes, that's
Whether
correct.
in stock account, brokerage account, CD, something of that nature, they're going to see a little reserves in there. Debt ratios sounds like they're going to be a little more strict, which by the way is typical for jumbo financing. They're going to have about a 40, like a hard 43% or less. It sounds like this is similar in that respects as well. Is that correct?
Yes, that's correct.
Okay, cool. And then earlier you said it, which was the loan on this thing. It's a 30-year fixed rate. Is that correct as well?
It actually, I thought we had the fix, but it is an ARM product. So we have a 5/6 arm, we have a 7/6 arm, and a 10/6 arm.
Okay.
And what an arm is an adjustable rate mortgage.
So not the 30-year fixed rate, which is by the way normal, which is what I was asking. So I misheard that I think earlier. So we have ARM products, which is normal, air quotes, normal for these type of products because again, these are typically reserved for the newer doctors, the newer medical professionals, the PAs, the newer doctors, where they've come into the new money, right? They haven't had the chance, they haven't had the long-term savings of doing this for many, many years. And the idea is they get in there and they have this product for I think you said a 5, 7, and 10-year arm. Is that what I heard?
Yes, that's correct.
So you can have it to where the rate is set for that first. You pick the arm, right? Whether it's a 5-year arm, 7-year arm, or 10-year. And we'll put a link for arms if you're not sure or familiar with those are. But tremendous product to get you in the house, good rate, good program, keep your money. And then as time grows and you start to accumulate more assets from now making big money as a doctor or a PA, then obviously as things happen, you can look to maybe restructure a loan later on if you need to. You don't have to refinance arms. It's just a lot of times maybe you find an opportunity in that 5 to 10 years where there's an opportunity to refinance, maybe more of a fix or maybe buy another house. Who knows? Credit wise, what do we need? Is there minimum credit scores for this?
There is a minimum score of 720, and they don't really make exceptions to that. But if you're kind of on that borderline, we do have the ability to look at credit in our simulators and do a rescore to get you to that needed minimum score.
I will brag on you. This has nothing to do with the program. Krystal's very good at that. So if there are credit issues, she can absolutely walk you through how to take care of things. So 720, the minimum credit score. We've talked down payment, income. I'm assuming normal income as far as typical standard underwriting for income.
Yes.
Um, Single owner occupied only, I assume. Is that right?
Yes, it is owner occupied, but we could have a non-occupying co-borrower or co-signer if needed.
Got it. So if for some reason, just some young doctors coming out of school and wants to buy a $2 million home, can't quite get it, but maybe there's mom or dad with the ability to hop in and just make sure it happens, knowing that the income can still. Because I got a buddy that came out and did a doctor, and then he did another year of whatever it was and became a surgeon and got another pay raise. So I can understand how that'd be a thing. And owner occupied only, all states, I
Yes,
assume, or
all
all
50
50
states.
states. Fantastic. Um, Anything different between a doctor and a PA? Do we need to know? Is there any same everything, or is there any difference between the two?
No, we just have to document you know, the nature of their job. I mean, a physician assistant is the doctor that really does all the work, kind of like we do all the work with you, Mark.
Yeah, I was gonna say in this case, I'm the doctor, you're the PA. You're the one. I always joke with folks that Krystal does all the dirty work. I take all the credit, but it's true. You're amazing and incredible, and I do know that about nurses too, man. They make her and physician assistants. Um, cool. What else am I forgetting? No prepayment penalty.
No,
Um, Pretty plain vanilla, straightforward. Arms. If you're not familiar with them, we're not going to go into it here. Check out that. I know I have a video on arms somewhere. Anything else that I'm forgetting or questions I should be asking for this product?
no, it's a pretty straightforward product, just something to offer a low down payment option for those that are coming into the field or that just don't want to have to put a large chunk of money down when they're buying their first home. So,
And what I'll say, guys, is if you're watching this, it's 2025 at the time of this taping, and pre-COVID, doctor programs were really dominated by the local small bank, not even local small. Bank of America once had a great, and they still might. I don't know. I haven't heard much about it lately, but they used to be dominated by the banks, the true banks that wanted banking business. A lot of times it was more regional, smaller banks, Frost Bank, Amity Bank, Regions. Those were banks that were really aggressive on these doctor products. And back then, they would offer 100% financing. And they would do that because these young doctors coming out of med school, out of residency, they were banking on the fact that these young, men and women were someday going to have money to spend and need banking relationships, or maybe go out on their own and they need business banking relationships. That's why the banks did it. COVID changed a lot of things. These programs have become like really hard to find. I'm really happy and proud that we have one and we do offer one. Um, there may be something better. So we're not going to be naive to say we are the latest and greatest and things like that. Because what I have found with these programs, they can get turned on and off pretty quick by banks, even in today's market. So what I would say is absolutely, if you feel confident, you trust us, reach out to us, let us talk to you, whether it's Krystal or anybody else on the team. Let's figure out what it is you need and want. Sometimes while they do qualify for this, there may be other programs we offer as well that maybe satisfy some of the needs as well. So I would just say that don't accept this to be the blanket like end all be all. If you are a doctor or a physician's assistant, understand that this is one of the tools that we have that we can offer and explore, but it's not the end all be all. Krystal, do you agree with all that? Am I missing anything that you
no,
want to add to that?
absolutely. I mean, we always look at all possible options for every borrower. We don't just zero in on one thing and stick with that. We really want to offer the best available terms to each and every person. And sometimes it takes exploring different products to find what's going to work out best for each individual.
Yeah, and we do find kind of like the military, and I know that you do a lot of VA loans, but I find the medical professions the same way. Where the military, the medical professions, a lot of times they hear about products through their peers around the water cooler. Hey, you're buying a house. So with that, that's the other part we want to just convey is that please do let's make sure you're an informed consumer. We will help you discern whether or not this is the right product, whether it's with us or somebody else, and run through those options to make sure. Because at the end of the day, we know that if we do a good job, selfishly, it probably means more business for us. Even if we don't do this mortgage, we'll probably get the next one or the referrals too for other folks. So we will do a good job. We know we're good at that. But Miss Krystal, you're amazing. I know I had to like squeeze you in today, and you got a whole lot of other things going, but I think you did great and wonderful. We appreciate you. As
Thank
always,
you.
guys, thanks for checking in with us and learning about loans. We'll see you on the next episode.